All right. Hey, everyone. Welcome to another episode of Vyzer Visionaries. I'm your host, Litan, and with me today is Mark DiGiovanni. Did I pronounce it good?
Perfect.
All right. Well, welcome to the show, Mark. I appreciate you for joining us.
Thank you for inviting me.
So, Mark, I want to kick this off by first asking if you can give us a quick, you know, 2 minute background about you, your firm, and what makes you guys kind of unique, like in a couple sentences. I'd appreciate that.
Okay. I've been a certified financial planner for about 30 years now. Started Marathon Financial Strategies back in 1995. Um, got into it sort of an unusual way. I had worked as an underwriter in an insurance company, and when I was there, I had completed the CPA designation and got my MBA in accounting. I had people coming to me for informal financial advice at the office and started looking to see whether or not this was something that I could make a living at. I enjoyed being able to help people. So that's kind of how it led to it. Um, I didn't I didn't focus on trying to make money early on. I wanted to just establish everything. So I think my motivation was right from the beginning in terms of wanting to help people more than about wanting to just enrich myself. That came later, but that's always been my focus, and it's been more about I want to be able to help the people that probably need the help the most, and by that I mean, if you've got $30 million, you have no shortage of people that are quite willing to help you. But if you have $2 million, there aren't as many people willing to step up sometimes to be able to help, and I find that uh, sometimes those clients become the best ones. For one thing, they always appreciate the help more, and sometimes they tend to listen better too. Not that the ultra high net worth don't, but they they have the ability to second guess you a little more, shall we say?
Yeah. Would you say those clients who are in that phase? Because as I've so my background, I'm not a background in my background is not in financial services. It's in tech, and I found myself in it because I sold a company and started investing, and I
Hmm.
started to understand that the terminology in the industry is kind of I'm not going to say misunderstood, but it kind of means different things to different people. And so when you talk about financial planning or wealth management, and you say that number of 2 million or 30 million, do you refer to total assets or total net worth, or is it assets that you manage for that client would be 2 million or 30 million? What does your firm specialize usually?
Okay. One thing is I've decided not to set a minimum. Now, kind of by default, there tends to be a certain minimum because there's a sliding scale in terms of the fee schedule, and it doesn't sometimes become economically viable for someone, say, with only $250,000 of investment assets to use me. However, I also, if they want to use me and they know what the fee is and they think it's worth the money, I don't want to turn them down just because they didn't hit an arbitrary number. Um, the two requirements that I have as far as in order to be able to client, there are two things. One, if you're in the accumulation phase, which is typically pre-retirement, you need to be doing what you need to do to hit the long-term goals that you have set for yourself. And by that I mean if you're 45 and you want to retire at 55 with the equivalent of $100,000 a year, but you only got $40,000 in your 401k plan, you're probably not going to make it, right? So because you're asking me to perform some kind of a miracle with what you've got, and you're not doing what you got to do. So we have to adjust some of that. So that's the first thing is if you're in the accumulation phase, you got to be doing what you need to do to meet the goals that you've set for yourself. And then in the distribution phase, which is typically after you retire, you need to be able to have the assets necessary to meet the obligations that you're going to have for what the expected life expectancy is. So in other words, you're going to be able to. You, I don't want clients that are going to be outliving their money. Uh, that that's not good for them, and it makes me look bad too.
So when you serve clients, is it holistically? Is it end to end, or is it more from an asset management perspective, a chunk of their money that you manage for them, maybe their 401k account or some other brokerage account? Um, how does it usually work in your firm? Is
No,
it,
I've always taken a holistic approach, okay? Because, money is a tool that we use to be able to accomplish the things that we want to accomplish in life, okay? And you don't look at it as more than a tool. It's a very valuable tool. It's the best one mankind ever created, uh, but it's got to be managed properly. But when I talk about, doing that, I want the client to be able to tell me what it is that you want to be able to do. Whether it's, in your younger years, when you're still raising a family or whatever, or when you get to retirement, finally get to do whatever it is you want to do, to be able to articulate that. And then my goal is to be able to help them accomplish those types of things that they want to be able to do. But I take a look at the overall picture. So, for example, somebody comes to me, and people typically seek out a financial advisor when they're going through some major change in their life, right? They've gotten a divorce, the parents have passed away, left them something. They're about to retire. These kind of major life changes that they have. So one of the things is when somebody comes and they're saying we're about to retire, and they've been working the same job for 35 years. They were at the top of the pay scale. They couldn't do anything else to make that amount of money. They may not have been particularly happy doing it by the end, but they had to get kids through college. They had to get the mortgage paid off and everything. And all they can think about now is, I don't want to have to work. But they have a lot of their identity tied up in their job. They also, had 50, 60 hours a week that they were spending on it. So one of the things that I try to do is make sure that they understand all of the psychological changes that they're going to go through. We want to walk them through that so that they understand what's going to happen. And they may decide, and sometimes I encourage them, go find a part-time job. You may have been a CEO at a company, but you may end up working at Home Depot 20 hours a week just because you like being able to do that. And that makes you feel like you're making a contribution, whereas you can't play golf 7 days a week. I mean, you might try for about a couple of months, but that gets old in a hurry. So, people need to be able to find the purpose in their life too.
all right. I appreciate that, and it makes total sense. Now, let me go back sort of to the beginning from a chronological standpoint. How do you reach new clients? Is it all word of mouth? You do marketing? What do you usually
It's
do for that?
Yeah, it's pretty much all word of mouth. I try to get out, do some public speaking, things like that. But generally, what I found is, I've tried advertising in different arenas, things like that, and for the most part, it doesn't really work. Partly because the most the most important characteristic when they survey people about what they're looking for in a financial advisor is, can I trust this person? And advertising doesn't tend to bring that across. Whereas if you know somebody, from your church or in your neighborhood or at work, and they say, I've worked with Mark DiGiovanni for 10 years. He's really been very good. He's very trustworthy, that kind of thing. That carries much more weight than a $2 million advertising campaign ever could. So that's generally what brings people to see me.
Like a lot of things, though, it's not under your control, right? That's you just want to do good and give your clients a good experience and make sure they're happy, and then as a
Yeah.
byproduct, but you can't really control that, right? So clients come in through predominantly word of mouth. How does the sort of first conversation or onboarding process look like?
Well, I will send them a financial questionnaire, first of all, for them to fill out. One thing that does is it lets me know, are they seriously looking for financial help? Because if they don't take the time to fill out the questionnaire, then I'm probably not going to waste any more time. And I'll give them a couple of opportunities to do it, a couple of follow-ups, but I'm not going to, drag them kicking and screaming into an office for a meeting or anything like that. So they'll fill out the questionnaire, and the questionnaire is kind of two parts. One is what I call the essay. And I'm asking about, some of your experiences with money. What are your feelings about it? What are the good and aspects that you see? What's the best financial decision you ever made? What's the worst one you ever made? So it's kind of like they get to do a little bit of thinking about their perception of money. And then we get into the data, your assets, your liabilities, your income, your expenses, all that kind of stuff. But when I get that, then I can sit down and look at that, and I get a pretty good snapshot of who I'm going to be talking with before we ever sit down for a meeting. And then what we do is we will get together and, we talk for an hour, hour and a half. They typically run about an hour and a half, but I don't set a time limit. And, we talk about what it is they're looking for, how they think I can help them, uh, whether their expectations of both me and their money, make sure that all those are realistic. And if you feel like it's a good fit, what I tell them, and it's on my website, I see that as a first date. Okay, we're both getting to know each other, and they have to qualify for me as well as I have to qualify for them, because I'm not about to take on a client that's going to be a problem. And by that I mean someone who won't take advice, will always be questioning everything. Now, reasonable amount of questioning is good, and I encourage it. Um, but why would you pay me for advice that you have no intention of following? That's a bad use of your money, quite frankly. So, I need to know that we're compatible in that sense. That it'll be good, because this is relational. It's not transactional. Uh, I go in with the idea that, um, these will be clients until one of us is dead. Is my approach. So, and I tell my clients when we're doing planning is no client of mine ever dies before they turn 90. That is not a promise, but it's a planning tool.
I like it. So it's interesting because I assume the more sort of DIY or do-it-yourself investors who like investing with their friends in like a startup or in a real estate investment, do they tend to be the more, I won't say difficult ones, but the ones that you kind of prefer not to work with then, and more prefer those who like entrust everything with you guys, or is it a blend?
When I started working at that insurance company, when I had my 6 month review, one of the things that my manager told me that stuck with me for all these years was, he said, "You now know just enough to be dangerous." And I think that that is very applicable in so many aspects of life. That you dip a toe in those waters, and after a while you think, I really know a lot about this. Uh, Another analogy is, when a young driver gets his license, okay, he's very careful the first couple of weeks or whatever. But when he's been driving for 6 months, he thinks he could drive Formula One cars or something like that, and he knows just enough to be dangerous, and that's when they have a problem. So sometimes some investors, that's what ends up happening. They've played with it for a while. They think they know it all. But one of the things that's interesting too is that, numerous studies over the years have shown that investor success breaks down into three different categories. 10% is investment selection, what stocks, bonds, funds you pick. 20% is asset allocation, your ratio of stocks to bonds, that kind of a thing. But 70% is investor behavior. And because that's the real factor, what does the person do? What kind of mistakes do they make? That kind of a thing. That's how I basically allocate my time. I spend 70% of my time trying to manage my clients' behavior, because it doesn't matter whether I get them an 8%, a 12%, a 20% return on their portfolio, because if they're doing things that are really going to screw them up, then I can't do it. I tell them, look, there are two things I am not. I am not a miracle worker, and I am not a janitor. So if you screw something up royally, don't expect me to come and clean it up. All right. What you want to do is you want to come on the front end and tell me, I'm thinking about doing this, and then I can give you some advice. And if it's a good idea, then I'll be very supportive of it. But if it's a bad idea, I'm going to tell you, and tell you what the possible consequences are. So it's trying to keep that emotional aspect of the clients in check.
Yeah, I think the whole aspect of investor behavior is such an interesting aspect of it. I even take it to an extreme where sometimes for some people, I think liquidity is more risk is worse for people than it is good for people to have liquidity in the private market in the public markets, because then you make emotional decisions that you can act on, whereas illiquid assets you can be as scared as you want, but you won't be able to do anything about it. And you know it's exactly protecting people from that behavior sometimes.
Well,
So
yeah, and I'm old enough to remember, watching Walter Cronkite on the CBS Evening News. And When Walter was doing the CBS Evening News, if the market moved 1% in a day, that might be Walter's lead story. Okay. Now, if it moves 1 to 2% a day, it doesn't even make news. I mean, Bloomberg will tell you, but it's not going to be the lead story on CNN. Why does it move so? Why is it much more volatile now than it was then? Well, because back then, people didn't have 401k plans. They had pension plans at work that were professionally managed, and those were people that were managing impersonal, dispassionate dollars, and they were always thinking long term. All right. Today, the average employee goes in, he fires up his computer. What's the first thing he does? He sees what his 401k is doing. On a daily basis, he's checking this thing, and he's making decisions and buying and selling and stuff based on whatever the market did the day before, whatever the news is, and all of that is just creating so much volatility. It's shaking the machine constantly, and I think that's a real problem that you've got right now. But those people never end up doing any better than the people who do a simple buy and hold, check it, every 6 months or whatever to make sure you're allocated properly. Do you live in a big city? Where do you live?
I live outside of DC, so pretty big.
DC, okay. All right. Then you are familiar with traffic in big cities, all right, and driving on expressways. You ever been driving down an expressway and there's always some guy that's changing lanes like every 2 seconds, right? Okay. And you get 5 miles down the road and he's still in the same place relative to you that he was back then, right? But he's changed lanes every time. Now imagine if he had to pay a couple of bucks every time he changed lanes, all right? He'd be further behind than you when the bottom line. And that's these people that are constantly trading. They're going back and forth and back and forth, and they're not really making any progress compared to the people that are patient and do a buy and hold. So
I love that analogy. That's a really good analogy.
Yeah. And every time I see this guy going back and forth or whatever, it's like, man, if you had to pay for those lane changes, sometimes they do through accidents or tickets or whatever.
So this brings me sort of segues into, the elephant in the world at the moment, which is AI, and how it's affecting everything. And just like, and I've spoken to both wealth managers about this, but also with other industries, you hear doctors complaining that every patient is now a doctor because they have, some AI bot in their pocket, and then they have to deal with bringing the person back to reality, and that, okay, fine, but there's this and this and this and this.
Mm-hmm.
And with all due respect, ChatGPT or Claude or whatever it is, let's do that, not what they're saying. I've also heard similar conversations happen in the wealth management industry between clients and their advisors. Have you been seeing that as well?
I haven't had any clients come to me, with any AI tool saying, what about this? What about that? But, it's been 15 years at least since you could go online and you could get a portfolio created for you by, this website or that website. So it isn't anything new in terms of portfolio creation or investment selection, stock picking, or anything kind of stuff. That's been around for a while. AI may be taking it to another level, doesn't necessarily mean that it's going to be any better. But AI is never going to replace the human touch. And that's the thing that I think going forward, the financial advisors who have or can make the human connection, who can talk to clients like they're people, who can convince them of the things that they need to do, who can be empathetic, all of those human qualities, those are the ones that will do well. Someone who is just in the analytical aspect of it, their jobs are going to be at risk because AI may be able to do it better and cheaper. But I think as long as you're the one that can sit there and talk to the client, make them feel comfortable, and keep them on the right path, then I never worry about AI. One of the things I always like to hear, and I tend to hear it at the end of almost every meeting, is when a client comes in at the end of the meeting, they say, "Well, I feel better now." That's always my goal, that they walk out of the meeting feeling better than they did when they walked in. Because usually when they walked in, there was some issue that they were grappling with, and we were trying to find a solution for it. And sometimes I can't always give them the answer that they want, but at least they know where they stand at that point, and they have some direction going forward. But also too, having a certain level of accountability to a person makes it much more easier for them to be able to follow through on the plans. Okay, AI can tell you what to do, but AI can't follow. I mean, it's not going to follow up or make you feel guilty or whatever if you're not doing what you're supposed to be doing. Again, that's that human touch that AI will not be able to replace. So AI
That's a
doesn't
really
make me lose any sleep.
Yeah, that's a really interesting though aspect to it. The fact that humans or wealth management advisors can hold clients accountable, whereas getting some input or advice from an AI bot, all right, you need accountability in order to take action on something, and that's also where the human brings even more value. I love that. I haven't heard that before from anyone I've
Well,
spoken with. It's
and
really good.
and what I tell my clients is like, first of all, I tell them, sometimes I always call and they're apologetic about, I don't want to interrupt you or whatever. I say, look, you're never an interruption of my work. You are my work. All right. And I tell them, if you're making any financial decision that involves more than about $2,000, $3,000, you need to give me a call. Okay. I don't necessarily know, what kind of granite countertops you're putting in on a kitchen remodel. Okay. But if you're thinking about dropping 50 grand on a car, all right, run it by me. Not so much. I mean, partly to make sure that the best way to be able to pay for it, but also too, I do research on things like what cars are good. So if you're telling me you're thinking about this car and I know this reputation is terrible, all right, I'll let you know. I said these are some alternatives. At least go and test drive some of these other ones. That kind of thing. I want them to know that I'm looking at, again, the holistic thing is anything that's going to affect it. Because I know what happens is if they make a mistake on something, what they're going to do is they're going to try to recover it out of the assets I'm managing. And when they do that, I got fewer assets to manage, which means my income went down. So I don't want to have to
Yeah,
pay for somebody else's mistakes.
that's also another good incentive for advisors to give holistic advice because it does affect them as a byproduct. If that decision that wasn't under their management was a bad one, it will come to bite them up
Right.
later if it was a bad decision.
Well,
I like
and
that.
every once in a while you get a client, maybe because they're retired and they're bored or whatever. It's like, I think I'm going to do some real estate investing. I think I'll get some rental homes. Right. Of course, when they do that, the first question they ask is, "Are you looking for a part-time job? Because you're going to have one whether you want one or not if you become a landlord." And then they buy this money pit, and then they sell it, 5 years later because they're tired of being a landlord and they lost 150 grand on the thing. And where they're going to pull out the money? They're going to pull it out of what I had, under my management. So uh, everybody loses on that one. But if they had asked me about it on the front side, might have avoided the whole problem.
Yeah.
Just an
Mark, I love this conversation. I can go on and ask you a bunch of other questions around these topics, but we are at time here. Just, rounding it up, is there anything sort of you want to leave our audience with, like just thought they should think about, questions they should ask their advisors, any sort of last, nuggets of wisdoms?
Okay. There's one nugget of wisdom that I always have, and I've said that if I could only give one piece of financial advice, this would be it. And it's an old Arabian proverb, and it goes like this. It says, "Plan for your future as if you're going to live forever. Plan for your afterlife as if you're going to die tomorrow." And I think if you follow those two things, you'll do all right.
I love it. Mark, this has been a super interesting conversation. Thank you so much for joining, and thank you all for listening. I'm going to leave Mark's contact info in the show notes, so feel free to reach out to him. And as usual, keep investing wisely. Don't make stupid decisions. Have a great one.
Thank you, Litan.